stocks, and he has spent his entire career in Dallas, Texas, which, as most of you would know, would be one of the warmer places in the US until about 2 weeks ago, where that all came crashing down, unfortunately. David joined the World Equity Group in November 2019, and previously he was with Esposito Securities, where he helped build their REIT platform with institutional investors in equity REITs. And prior to joining Esposito, David spent 11 years at Green Street Advisors as Vice President of Institutional Trading. As you'll know, Green Street is one of the premier houses when it comes to REITs globally. David is a frequent commentator and has been quoted by Bloomberg, the Wall Street Journal, the Financial Times, REIT.com, and the GlobeStreet.com, amongst others. David graduated from the University of Texas at Austin with a BBA in finance, and he also holds an MBA in finance from the Southern Methodist University. And in the US, he holds a FINRA Series 7, 24, 55, and 63 registrations. Also welcoming Ray. Ray Moore has he works with Raymond James in New York area as a managing director. I think it's the second time Ray has joined us from home, still not back into the city, I think, and heaven knows when that's going to be. Ray has got over 30 years of experience, and I think you'll definitely see that coming through in today's discussions as well. Ray holds a bachelor's degree in business and managerial economics from Long Island University, and prior to joining Raymond James, he has worked with RBC Capital Markets and Piper Jaffray, and he holds Series 7, 63, and 24. So welcome to Ray. David, thank you very much for making your time available this morning, your time. Just to set the stage, this is our second one of these. It's not exactly a year apart, but close. But just to set the stage, and if we go back a year, if we look back a year ago, the COVID had 2,710 global deaths. The US had its first deaths already, but actually none that were officially known at this stage in February. So a very different world. Fast forward a year, we're sitting in a global situation where we have 2.5 million dead, 506,000 plus in the US. It's been, I think, a year of tumult, volatility, a lot of negativity with some people in the markets, a lot of positivity. In REIT land, though, I think there are many of our indices that we're still waiting to actually get back to level where they were last year this time. So it's been quite the ride, and I'm pretty sure it's not over yet for a long way to go. So to set the stage and get us going, I'm going to start off with David and just get his thoughts as to where he thinks we are in the real estate cycle and the COVID cycle at the moment. Thank you, David.
Well, Garreth, thank you so much for having me, and I really appreciate it. I'm honored to join everybody here, and I hope wherever anybody is listening that their families and everybody remains safe. And we, of course, like everybody else, look forward to doing this in person. I miss seeing everybody's faces and being around folks, so thank you. It's a very interesting question that you posed of where are we? It seems like if you talk to a lot of folks, they would say we're on the other side towards recovery. And if you talk to a different set of population, they would say we're still in the same place where we were back in March and April of last year. As a result, I feel like it's a little bit of both here in Texas, and I'm sure Ray would say the same in New York. The vaccine rollout does continue. If you listen to a lot of the earnings calls from a lot of the domestic REITs here, to date, they talk about the green shoots that they're seeing. Yes, we experienced some pain. What we saw in the back half of 2020 gives us good signs into 2021. And as we recover, we expect to see a healthy into 21, into 22. So I think right now from where we sit, the work from home trade currently stays in effect. Thus, the use of tower REITs, data center REITs, the popularity of industrial REITs, I think you're going to see those to continue to perform very well. As well as the shift away from urban to suburban, from primary to secondary type markets. So some of the suburban office guys, the single family rental REITs, I think a lot of the sectors that were very popular in 2020 are continuing to go down that road into 21. And until we see some kind of what I would call herd immunity, as they're saying here in the States, and it's fully rolled out, I don't see any reason why that trade would not continue going forward.
Excellent. Thanks very much, David. And Ray, your feelings, do you agree with David at the moment, or do you have anything different?
Well, where we are as far as COVID and where we are as far as stock price and performance can be two very different things. I think David's 100% correct. You know, the guys with the fundamentals keep the fundamentals, the digital guys, the tower guys, you know, all these guys, the industrials. However, since the beginning of the year and since the reopening trades really started to happen, you've seen those stocks underperform as investors bet on the reopening, right? So now we have subsectors like lodging at valuations where guys are really struggling to justify, but nothing's really stopping them right now because it's just indiscriminate money going after what's going to happen, you know, in a reopening. Another area where I think David's right out spot on is the single family rentals is a name Raymond James loves. We think they probably have some of the most upside in that space. So it's kind of like it's a have and have not. It's like, you know, are we to the point in COVID where malls and shopping centers should be trading where they are? I don't know. I mean, but I'm not sure that. I think the stocks have certainly gotten ahead of where the virus is right now.
Definitely wouldn't disagree with you on certain of the sectors. And I think that's a good segue where we can start moving into, I think, discussing sector specifics. And in particular, as you touched briefly there on is retail. I think, you know, if we look at the top performers and the shooting stars of this year, who certainly still, a lot of them are still trying to make up what they lost last year, but the outperformance this year, especially since November, has just been phenomenal on retail REITs, and you know, whether it's malls, strips, it's just, yeah, I think we look at it sometimes and shake our heads with some of the counters who are starting to actually trade levels above where they were last year this time, and you've got to question, does this actually make sense? And for us, we're not convinced that it does for many of those counters. David, your thoughts?
You know, you make a really good point as you mention the recovery of shopping centers and malls. And from where I sit, I still feel that the grocery anchored centers continue to perform very well. People still go to the store and they have essential needs. You know, some of the malls, I think those with an outdoor type concept are holding up better than what you would call an indoor concept, because a lot of those are not really open or fully reopened. Plus, I'm also still a big believer of quality over quantity. And so for some of these super grade A type assets, you know, like a Simon Property Group with such strong assets in their portfolio, you know, you would bet on the long term. These guys have faced recessions and challenges and economic hardships across the globe for many years. But I feel, as we've discussed, I personally feel that where folks see challenges, a lot of these guys find opportunities. Go read some of the commentary from the mall REITs during their earnings cycle just now, and they'll talk about how active their leasing pipeline has been, that they're signing new leases, they're finding new tenants. Some of these guys are getting higher rates than what they were signing for pre-pandemic. And so, yes, on the surface, from the talking heads, would have you believe things are pretty rough. But at the end of the day, you know, these guys have been in business for a long time, and I personally feel like they know what they're doing.
Good points. And Ray, is your house view pretty similar? Are you seeing the same things? You also have the confidence in
it is similar. You know, one of the important things to remember is that COVID's been most dangerous to anything with a pre-existing condition, and that includes real estate, right? So if you had a B or C mall, you were already in decline before COVID hit. COVID just accelerated a lot of these existing trends. You know, as David pointed out, grocery anchors are super strong. They're going to, you know, Raymond James thinks they're going to stay strong. You're actually seeing mall retailers move to some grocery anchored strips, right? And I'm not saying, you know, there's going to be a Brookstone next to the, you know, the Whole Foods, but you're seeing certain names that are historically mall retailers start to move away from the malls into the strips. Now, I don't know if anybody would argue that there's still 50% too much mall space, but very different class. Again, as David pointed out, like if you have an A property as this cycle kind of makes its way through, that property is going to be actually worth more, not less, as space kind of starts to run out. But Ray J definitely likes the grocery anchors. We think that the more suburban malls could probably fare a little better, just with the whole move out of the city and into the suburbs. We like the triple net space. The better the tenants, obviously, that's also the haves and have-nots. If you have a good tenant, you're going to see cap rate compression. If you don't have great tenants, it becomes a little bit more tricky. So, and also one thing to watch out for in the shopping center space, you're going to see higher FFOs, but they're also seeing a lot more CapEx and stuff like that kick in. So the AFFOs may not move as much as the FFOs, but again, it's the haves and have-nots. I think Dave wants to say something.
I just wanted to add, you bring up a great point, Ray, and I didn't touch on the net lease, but I mean, when I think about over in my neck of the woods, the gas station, the Starbucks drive-through, the Panda Express, or some of these out parcel type QSR quick service restaurant places, they're lined out the door. These guys are getting 100% of the rent collection. The net lease REITs that own a lot of these tenants, they're at 95, 98, 100% rent collection. So for a lot of these guys, I don't say this, jokingly with a pun, but for some of these guys, it's COVID schmovid. I mean, it's just another hiccup in the grand scheme of things. But for a lot of these guys, it's business as usual. They're focusing on improving their operations and tenant relationships, diversifying their tenant bases, high, strong quality relationships. And Ray just touched upon that. That's what these guys are really working
with. Another subsector to put in that same bucket with super high, ridiculous rent collections are the gaming REITs. A lot of people were worried about these gaming REITs going into, they've got all this exposure to one tenant. And now it turns out that, that ended up being a good thing because they've collected 100% of the rents. And they do trade at a discount to some of the other names, the triple net names, stuff like that. So it's like, that's a place where you're starting to see people start paying a little closer attention to, because nothing could have gotten worse for gaming, but yet they collected 100% of the rents.
Ray, before you go any further, do you want to just give a bit of an overview of what a gaming REIT is? So, because a lot of our audience in South Africa have never come across that asset type, because we don't actually have it really in South Africa at all.
Well, I can't, under Raymond James guidelines here, I can't get into specific names, but there's 3 of them.
No, yeah.
And it's just, you're basically, it's kind of like the old buy-back model, where, they sell the real estate and they also provide the growth too. And they kind of work hand in hand. It's controlling the real estate versus the business part of the gaming.
I will tell you what those 3 companies are, since they technically cannot. I'm not going to say recommendations or anything, but the 3 primary players here in the States are a company called MGM Growth Partners, which is I believe a full-off spin-off of MGM Properties. The ticker here in the States is Mary Green Paul MGP. Another name is Gaming and Leisure Properties. The ticker is GLPI, Girl Larry Paul Indian. And the last big player here is Vici Entertainment. Their ticker is VICI, Victor Indian, Charlie Indian. Those are the big 3 gaming REITs here in the States.
Yeah, and I think if we look at those, if we think back to, let's say 11 months ago, their prices were massively hit by the COVID crash. And whereas the underlying cash flows were something completely different, because they were basically all contractually guaranteed and they just carried on coming in, whether people were there or not. And I think it often just, COVID, I think, created a lot of potential opportunities for investors who were sitting with cash and who were ready to take advantage of this, because the market just really overreacted, and potentially in a way still is overreacting, and how much I think good quality REITs have still been largely ignored instead of the Teslas and the bizarre GameStop trades and things that have happened, where we're finding, in our opinion, we're seeing excellent quality real estate trading at great value, and the rest of the market really just hasn't come across to it. And I'll lead on to another thing I'd like to discuss too, is where even before we've even recovered, these people are starting to talk about rates moving up again and hyperinflation, which are things we just think are kind of crazy to talk about at the moment, considering the reality. And your guys' thoughts on that would be great.
Well, inflation's a funny thing, right? So everyone talks about inflation and they worry about REITs and they worry about yields because the yield plays, but I don't know of a better place to be than in a hard asset, assuming there was massive inflationary times, right? And look, no one's worried about inflation yet, but there's a lot of talk going on about it. In other words, the bark is way worse than the bite right now. I'm not sure how high rates can go if you look at the amount of money that the world is spending without completely collapsing everything. So it's not, I'm less worried about the rise in yields and inflation because we're in such a deep hole right now that I think it's, we're quick to point out it as a major trend, but we've got a long way to come before we get out of it.
Definitely. David, your thoughts?
I pretty much echo every single thing that Ray says. I personally traded a lot of preferred stocks here in the States, a lot of REIT preferred type stocks. And, everything is really based off of the 10-year treasury here. That's the benchmark that we compare to. And to see us go from, call it a 1% and change to 1.25%, or again, give or take a few basis points, but here we are year to date. That's still, yes, a big move, but still compared to historical norms and everything where we're at now, it's so minor that I agree with Ray. I think we got bigger issues to digest. When I chat with friends or family and people ask me, my response is, I think it's a little blown up. I say to the point that my example, I always say is when Walmart starts closing stores, when Coca-Cola or Budweiser starts closing bottlers across the globe, then we've really got some bigger issues that we need to be worried about. But right now, at this point in time, I personally don't think it's something to be aware of, but I don't think it's something that we need to be losing sleep over.
Then looking at the sector that really, I think, was the long-term winner from COVID, which would be logistics and warehousing. Obviously they performed fabulously last year. Results that we've seen, our results season have been great. They're still, doing fabulous business. Rents are still looking good. Cap rate compression, lots of growth, pretty much everywhere globally. But the share prices are just really languishing. If we look at the price differentials between something like a Prologis and a Simon, this year to date has been crazy. Your thoughts on industrial going forward? Room to run still?
Do you want to go first?
Yeah, go Ray.
So industrial is one of those sectors which it kind of flatlines, then everyone realizes fundamentals are still great, and then it makes another leg higher. Then everyone's like, oh, they're expensive, and then they, move higher. The reason why it's underperforming versus the Simon Properties right now is simply because of the reopening trade. Industrials were a crowd favorite, and the towers, the digital names, they've been a little bit of a source of funds for people to make their bets, and lodging, office, and all the other places that have kind of done better right now. But industrials may have seen peak occupancy, but fundamentals are fine. They're completely strong. The whole shift to online is not just Amazon. Home Depot, every Walmart, every Target, all of these guys have massive online delivery stuff now, and that's only getting bigger. You look at places like a cold storage, when you get really specific as far as industrials, companies in those guards and their competition, it's not a spot that's going away, and it continues to outperform, and that part of the market just continues to grow. And COVID just accelerated those things. And throughout history, they've looked expensive tons of times, and then they kind of pause for a minute, and then people realize the fundamentals are there to justify it.
So true. Great points. You've emphasized the cold storage because that was one point I was going to hammer on. It's the battle for last mile. That's the term they always kick around, last mile delivery. We're getting to the last mile. And all these guys, that's what they seem to be focusing on. Personally, and I think Ray will agree, we are starting to see a couple of headlines of some of these guys just going up full out speculative development. And historically, at least from my experience going back to the days of Green Street, when some of these REITs started really focusing on the spec development side of things, that can kind of tend to be a little toppy, is because when things get to be a little bit crazy, then there's not enough, tenants to potentially fill the space that's been developed. But there's so many ways to play the industrial space right now. As Ray mentioned, it's not just Amazon. There's so many other folks. look at the growth of Lineage Logistics, which is not a publicly traded company, but yet it's the only really competitor to our publicly traded REIT, Americold, ticker COLD here in the States. One other interesting angle to play for those that aren't aware is for those that have embraced, the cannabis trade here in the States, there is one publicly traded industrial REIT that has a cannabis spin, and that ticker is Innovative Industrial, IIPR. There are a couple other REITs that do have a cannabis focus, but from an industrial perspective, IIPR is a first mover and has been here, 5 years now, 4 years publicly traded, and it's one of, if not the top performing name pretty much every single year. It's right up there in the top performers. So we are seeing a big push. And as Ray said, yes, I think we still have a huge runway for this to keep going.
Excellent. And then the next sector I'd like to discuss is one obviously that's been in the target really of COVID, and who's faced it probably more than any of us, which is the medical sector, and how your views are on whether they're going to be also benefit from a potential reopening trade as they return to more normal, especially on their senior housing facilities. What your views are on them for the rest of the year, if you want to go first, Ray.
So skilled nursing is an area Raymond James is not worried about. We think it's fine. Medical office has been some of the worst performing. We think fundamentals are fine. Senior housing is where it gets a little tricky because COVID knocked them back about 5 years. So that's where things can become a little tricky. But overall, Raymond James thinks, skilled nursing, medical office is fine, and probably, depending on the pockets, a good place to have, an allocation.
I take a big 10,000 square foot approach when it comes to healthcare. I personally feel it's one of the only sectors that's going to literally make money off of every single person in some form or fashion, whether it's rehab, a physical therapy, going to the doctor's office, senior living, hospice care. There's so many different segments of it. And if you read some of the transcripts from some of the guys that have reported so far, they talk about how their occupancy has been hindered due to vaccine rollout and restrictions that are in place. But in the same breath, they talk about how 80% of the population in our communities have received their first shot. And once people get more, then the doors will reopen. And so I feel like there is a long way to go there. It's clearly been under focus for a long time, but let's be honest, we're still going to always have to go see the doctor. We are going to go to the doctor's office. A lot of these guys are reporting pretty strong rent collection from their medical office tenants. So I do feel like that there is still a good trade there to play.
Excellent. And then I think the next one is probably also one of the more contentious ones, which if probably after online shopping and the death of retail attracts the most column inches and hot air, which is offices, work from home, and the death of people ever returning to the office, space reductions of everything from 20 to 50 to 70%. Where do you think we're going with this? I have my own views, but I'd love to hear your views, Ray.
So Raymond James loves the Sun Belt. That's where we see, the trends in office as well as apartments and things like that. So the Sun Belt, we think, is going to continue to be strong. I was out the other day with a big private equity guy. They own a bunch of office and stuff like that. We were talking about the return to the office and whatnot. They've been going into the office for the most part, and they own a bunch of it. He was like, look, maybe I have 20% too much office space. He goes, but the leases are so long. He goes, I don't even think anybody's going to give that up. He goes, because who knows what our growth is going to be at that point in time. He actually made the argument that it would be a good business model for, instead of like a WeWork, for someone to create a company just to manage everyone's extra 20% office space, because it just considers that flex. During the whole huge COVID hit, a lot of these names got completely crushed. I had a couple guys buying, names like SL Green and stuff on. There was just pennies in the dollar. It got way overdone. Where you stand in office, I think most people think that we're going back. Is there going to be a change? For sure. If 35% less people aren't in the office, then because of COVID, then you can make the argument that you're going to need 30% more space anyway to space people out more. But overall, Raymond James likes the trend head to the Sun Belt over the coast specifically.
I've heard so many different stories all across the spectrum, and depending on if you talk to the office REIT CEO, to the portfolio manager, to the guy that sits at the desk at the end of the day. And I think when it's all said and done, if I had a crystal ball looking out, let's say 2 years from now, and in air quotes, assuming everything is back to normal, I think we have a hybrid situation of what everybody is talking about. I really think that's what's going to happen. We're going to go back to the office. We're going to have bigger space requirements. There's going to be a segment that will be work from home forever. There will be a segment that will be, I guess, what they're calling hot desking, which is the new buzzword, I'm guessing. I call it A team, B team. A goes in Monday, Wednesday. B goes in Tuesday, Thursday, and everybody works at home on Friday. I think you're going to see some kind of hybrid type model. In addition, if we're noticing a push to the suburbs, talking to some of the guys that are up in the Northeast, why do I need to pay, let's say, $25 a foot to be in Manhattan when I can get a satellite office in Stamford at 10, I can get a satellite office in Greenwich for 12, and I can get two for the price of one. I don't necessarily have to be in the city, and my workers can be closer to home. But when it's all said and done, and I think I agree with every office REIT CEO and all the guys that are out there, there's nothing like collaboration that's in person. We miss seeing our friends, talking around the water cooler, having productive ideas, and more importantly, reading body language. Garreth, I love to joke around this. For all we both know, you and I and Ray are all sitting here wearing shorts under our desks right now because, we look nice up above, but who knows what we're wearing down below. And, my cat comes into the picture frame. You miss seeing these little things in person that I do think we're going to see some kind of return. Now, in the same breath, if you own a lab space REIT, one of the guys like the company here, Alexandria Real Estate, ARE, or some of these guys that are making a big push towards life sciences, those guys are in the office, no questions asked. They're working on vaccines and all this stuff, healthcare needs. So people are back to the office. A lot of people are still afraid to go back to the office. And I apologize to drag on. There was a really big article published on our Bloomberg here yesterday talking to several New York City office landlords saying, we're trying to do everything to get people to come back to the office. They've improved HVAC air conditioning systems. They've improved elevators. And now the next step that these guys are taking are really putting in COVID testing centers into their properties so that people could come in, get tested, be cleared to go, and then go upstairs to their office and inviting the street people out, the public, to come and get tested as well. They're trying to do anything and everything. And at some point, the domino is going to fall in some fashion, I think.
Yeah, and I think it's going to be interesting. I think it's more likely that we go back to something far more normal than people are assuming today. I mean, it's you said hot desking is new. It's something I dealt with literally 21 years ago at Anderson Consulting. We started off with new buildings and hot desking, and checking in and people not having their own space. And 6 months in, it stopped, and people booked space for a year, and then all of a sudden people booked meeting rooms to become permanent offices. And it's the same we've seen with investment banks, where they try to put everyone in an open plan thing, and 6 months later people start fighting about having offices and having their own space. So yeah, I'm kind of more skeptical on this, I think, than a lot of the guys talking about it potentially happening.
And one more point to add, for here in the States, there was a big transaction this week. CBRE, which is one of our big global commercial brokers, I'm sure that you've heard of, bought a huge stake in a co-working firm here called Industrious. So for those that think that the co-working space, the WeWork trade is dead, CBRE is going to take the other side of that, saying we're just in the early stages of this. So clearly there is a need for some type of office presence going forward.
And don't forget, good teams worked well from home because they were created and built as good teams in the office. I mean, I think that's one of the reasons why, you see so much success with this work from home, is because everybody pretty much knows each other. It's got to be tough to start a new job. Those people are doing it.
Yeah, no, I agree with you fully on that. I mean, for us, it's been completely seamless to go virtual, but our whole team has got over 10 years minimum work experience. We spent a lot of time together. So separating and being virtual has been easy. But if you had a whole team full of first year interns and things, I can't imagine would be easy. But I think this also leads into a little bit of our next session. You briefly touched on it as well, which is residential. And you've mentioned, Ray, I think how much your company likes the Sunbelt area. They're looking at residential in that and the various subsectors in residential. Your thoughts on that at the current moment and maybe looking out a year or two?
So while Raymond James does love the Sunbelt, there's definitely been some stabilization on the coasts. We'll kind of see how things shake out, but we definitely think that move to the Sunbelt continues. As we mentioned earlier today, we think single-family rentals have probably the most upside. And Raymond James has been pretty bullish on the home builders from the get-go. You can actually talk about the home builders a little bit with the rates. Yesterday on Toll Brothers Call, someone asked them about rates. They're not even worried about them yet. There's so much demand for housing and whatnot. A lot of that is a lack of supply on the existing side. But Raymond James remains pretty bullish on the home builders. We do like exposure to the Sunbelt, really like the single family rentals. And as far as the coasts, you have to be careful. The moves are certainly, people are certainly moving out. There's some supply issues there, which is why we like to focus towards the middle.
Right. I think you are seeing some of the risk players, though, the guys that are looking at the recovery trade, they are starting to tiptoe into some of the coast names again. And talking with some of my folks, I have one of my clients, and he'll tell me, I'm not exaggerating, it's at least once a week, oh my gosh, did you look at this name? It shouldn't be trading at this level. Yeah, it's San Francisco. San Francisco's weak, but do you think 5 years from now it's going to be like this? And again, I know COVID carries all, but people are looking towards the other side. From the safety side of it, yeah, of course, the infill Sunbelt type markets, here in Texas, as you know, a lot of companies are relocating from the coast towards Texas because of our tax structure and property values here. At some point, it does get a little overdone, as I'm sure Ray is seeing with some of our guys right now. But again, I'm also a big believer of the expression, if it ain't broke, don't fix it. And so right now it seems like that is the trade. People are just holding steady. Go look at a lot of the major skylines. The cranes are still being developed. They're still seeing a lot of these new tower resi type developments. I don't see necessarily as many garden style properties. I mean, again, depending urban versus suburban, but I don't see any holdup right now and why that should change. And again, single family rental, the biggest player in the space is based here in Dallas, Invitation Homes, and go read their transcript. And it's like, it's a bunch of cheerleaders on the sideline because it's just literally kicking on all firing cylinders right now. It's just going very strong for them.
And it's not uncommon for the death of the big cities to, people call for it all the time. Don't forget, after 9/11, no one was going downtown again. Nobody was going to work in a high building again. And downtown came back, bigger and better than it had ever been before.
Interns should not have been able to buy at One West in New York after 9/11. Right. And that's how property values got destroyed. And again, the expression, what goes down must come back up eventually.
Well, and places like New York and San Francisco have, just its deep history and infrastructure. It's easier for them to make that comeback. They can lower if you look at people moving out of New York City in droves, but the recent housing data in New York City is spiking, and it's actually highest at the high end because guys are picking off, tens of $millions of apartments, in what they think is going to be a bargain the next couple of years.
Because they're not planning more land in New York City. And by the way, we haven't really necessarily touched on it, and I'd love to get Ray's comments, but for a unique play about that, speaking about those landlocked type cities, are the companies that focus on the ground lease. So there is a big publicly traded player here in the States, the company named the Safehold, the ticker is SAFE, and they're the only company that focuses on owning a publicly traded company that owns ground leases. So it's an interesting way to, looking at the high quality real estate stuff that's in their portfolio, you are starting to see some other folks kind of get into that business again, because these are 99-year leases that these guys are locking in when they own the ground lease structure. It's just a very unique way I want to own New York, but I don't necessarily want to own this property in New York, but I can own the underlying land. So it's just a unique play.
Excellent. And then leading into, I think, one of the early winners of the COVID trade, which then ran out of steam a lot, is the data centers. And if you guys can touch on towers as well a bit, I think looking at where we see that in the next, bit of this year and maybe into next year, especially, I think towers have been even more disappointing than data centers recently. Some comments on that would be great.
I take a big picture view when it comes to the towers, and that if you go back to American Tower's former CEO, Jim Tassel, he made some really good comments a couple of years ago at an event that have always resonated with me. And I'll give you the 2 bullet points. Number one, this data points as of a couple of years ago, and this ties to the data centers. But as of a couple of years ago, the stat going around was that there was 24 hours of video posted to YouTube every minute. Think about in the course of a given day, how much content that means is being posted online and what that does to the cloud. In the same breath, when you talk about some of the tower REITs, if you go back and read some of the transcripts and looking at where some of these guys are growing, it's not here in the States. What they're looking at is overseas development. And Jim Tassel, again, from American Tower, said it best. If you go look at it someplace in a country, in your neck of the woods in Africa, where there's some places that are not fully developed yet, where they may still be on 3G technology or haven't even gotten that far, by planting the tower in place and bringing infrastructure to the country, that brings so much development opportunity and growth that it's literally a launching pad to take it to the next level. Here in the States, we just launched this 5G, but you don't think the guys are already sitting back working on 6G? So as a result, I think that we still have a long way to go here. It's a great trade. Love Ray's comments.
Yeah, Raymond James would agree 100% there. The towers and the digital guys have some of the best. I mean, they can't even keep up with demand and the growth, especially on the digital side. And it's, the world is always changing, right? But the rate of change is actually always accelerating, right? And it's, we're seeing that more now than ever before. The demand for this space is actually accelerating because everything has to be online and it has to become global. And it's just, it's a place where, Raymond James feels the fundamentals are so strong that, the stocks maybe have underperformed over the past, handful of weeks as the COVID trade kind of, flips around. But, it's a place where we feel pretty confident you could put some money and forget about it for a while because there's, the rising tide is going to float all boats.
Excellent, thanks. And then before we get into some audience questions, I think if we can discuss self-storage a bit. I think, we've seen some pretty fabulous results coming out of both the US, the UK, as well recently. I think it's a sector that probably was ignored a bit over the last year, but has just, I think, quietly continued delivering pretty spectacular results. So some comments on that, David?
We keep storing more and more stuff. We keep buying more stuff. Look at all the Amazon packages that are sitting on our doorsteps. I feel like there's still a huge way to grow. I think at some point, this is just me speculating. This is not me making recommendations, opinions. I think at some point we might see some more consolidation in the self-storage industry. There are a lot of, there's more private players than there are publicly traded REITs here in the space as far as the number of properties owned. But when, I look at somebody like Public Storage, which is the largest self-storage operator here in the States, and I always have this running joke with folks when I talk to them, if Public Storage goes out and buys a property in Lexington, Kentucky, do you know what that really does to the bottom line of their earnings when it's all said and done? And the answer is, it's a trick question. The answer is nothing. It's a non-event. If it adds a penny, that's even a stretch. For these guys to really grow, they've got to go out and buy 10, 25, 100, 250 properties for really to have meaningful growth. And so I think we are going to see some kind of, small mom and pop shop type consolidation, but the rates keep going up. These guys are really focusing on their occupancy growth. And more importantly, a lot of these guys are making a push towards their third-party management platforms. And you're seeing a lot of leases being signed under third-party management contracts. So I feel like they've dealt with these pressures before, and yet they continue to keep reporting really strong numbers.
It's kind of like the industrials where people start worrying about valuations, and then all of a sudden they deliver results like we just seen. And as David pointed out, most of this business is owned by mom and pops, and think about the technological advances or advantages the public guys have over those mom and pops as far as collecting business and whatnot. It's a great business. I mean, I think the average lease is probably a month, maybe 3 months. And the average person stays like 10 years. It's kind of like, a Hotel California. Once you're in there, you're kind of locked in because you've got to put your crap somewhere. And as the housing market heats up and continues to stay hot, and the more movement you see there, that's all good news for storage. You're actually seeing, like, for example, my father just sold his house. We put a bunch of stuff which we're never going to need in storage. So that's just, public storage is collecting $250 off us now. And it seems to be like a nonstop business model. And the results dictate that. So we continue to like them here. You're on mute.
Again, I look forward to never hearing that you're on mute again one day. That'll be great. To the audience, please feel free to send through any questions. We're happy to take them now. While we're waiting for that, I'm going to lead off the question to both David and Ray. So we're a couple of weeks into the new presidency. Any thoughts on the impact on real estate that might be coming through from the Biden administration that we should be aware of? Maybe.
I don't know. That's a tough one. I probably have some opinions that would get me in trouble, I guess. There's no upside. Look, I think that the key here and the impact on real estate is going to be, there's a $1.9 trillion spending package which is coming to the pipe. And right after that is probably a $4 or $5 trillion infrastructure spending package. And it's probably coming right behind it. You can't have that much spending without having it affect real estate. And, there's just so much money out there. I can't imagine it's going to be bad news for real estate.
I would agree with that. Taking it from a big 10,000-foot perspective, Washington, D.C. goes through a turnover every few years or every administration, and yet the real estate always continues to, what I call, hold steady. It may go in waves like this, but D.C. still continues to perform as D.C. One interesting play, if you want to look at it from a government perspective, there are a couple of ways to play the REITs here in the States by way of the government. Again, not making recommendations, but just to throw out some of the couple of type players that you can look at. One of them just reported earnings in the past couple of days, and the company name is Easterly Government Properties. The ticker is DEA, Dog Edward Apple. Another interesting way, and this all depends on what your thoughts are about the post office here, because our post office is going through some budget issues and there is constraints. However, again, the leases are backed by the government, and there is one way to play it, and the ticker here is PSTL, Paul, Sam, Tom, Larry, and it's a private guy that owns a bunch of U.S. post offices. In addition, you have some of the guys that are focusing on, data centers in D.C., like corporate office properties. OFC is a way to do it. So I think that there are ways to play the trade around the administration on the edges, but as far as what does this mean for office REITs? I think the jury's still out on that one.
Yep. No, I think it's different market there to here. Here, we I know a couple of people who have post offices as tenants, and they're waiting a very long time to get their rentals. So a government guarantee as a tenant here is very different to a government guarantee in the US or Australia or many of the other markets. So it can be a bit of a nightmare. Any thoughts? I've got a question in a bit for us. So looking at, I don't know if you guys want to take it, or I can take it. Just looking at the European space, also potentially the UK, on any Brexit comments that you guys have, or I do.
Well, we talked about it last week, and I'd like to readdress about the whole Unibuy Westfield situation, because that has big implications for you guys across Europe, and it does for us here in the States. And so, I'd love to hear everybody's thoughts, because what does that say about US malls compared to European malls, compared to Australia or any other places in the world, with them deciding to walk away from the United States? And so knowing what I used to know about Europe, and again, this is more in your neck of the woods, but obviously I think that there is some huge implications by them making this decision. Ray, what's your thoughts there?
I don't pay enough attention to say anything probably worthwhile here.
That's good. Yeah. No, I think it's, I think it's more an attempt by them to raise cash by disposing of assets, and it's probably the one they can justify selling more than selling European assets, being primarily a European-based operator. Whether it makes sense or not is a completely different answer, really, as to whether they should be doing it. And it's yeah, it often, I don't think it makes sense to sell off some of the crown jewels of a company in the hopes of kind of just trying to avoid having a capital raise. So I think it's going to be interesting to see how the whole Unibay saga really continues to play out. So I think they've taken a lot of pain this month, but a lot of, I think investors have again, the price pushed down to the point where people have started coming back in and starting to look around that. We're also quite interested in some of the UK mall operators as well. We think some of those prices also have been massively beaten down to the point that doesn't make sense. I think I mentioned to you guys last time we had a chat that we'd seen a mall sold in the UK that sold for the equivalent of 5,000 Rand a square meter, which I think is about $350 a square meter, which is just it's crazy. So it's there are a couple of strange trades I think that we're seeing globally, but the important thing is probably not to anchor on those as becoming the be all and end all going forward, because you might have one or two of those, but the majority is, I don't think you're going to see that type of deal keep going through, especially as things start to come back to normal. But I think it's going to be an interesting opportunity, maybe Dave, if you want to talk about potentially, whether it makes sense for Simon to take those assets.
Quality trumps all.
Yeah, I mean, where do we end up in the US? Basically, I think probably with one giant mall operator and nothing else, and they potentially swallow up Macerich as well.
My running joke with everybody is I think Blackstone's the last man standing when it's all said and done. It seems like Blackstone is the partner to go to, hey, we need some help. Blackstone is your partner. Look how many REITs they've spun out. Either they're going to be the last man standing laughing at everybody else, or the whole ship is going to go down with them because they took such a big bet. But in the big scheme of things, nobody's ever bet against John Gray and Steve Schwartzman, who run Blackstone. Do I think we need to have several, A-plus mall REITs here in the States? No, I think that's why you saw Taubman merge with Simon here recently. You mentioned about the GameStop trade. That did catch one of our mall REITs in the crosshairs. That company was Macerich, MAC, who happened to lose their largest shareholder. The largest shareholder cashed out during the rally, the GameStop mania. And now Macerich is working with a debt relief specialist here trying to manage their debt obligations. So I think you're seeing some pros. There are some good stuff that's out there, but I feel like it's a niche type thing. There's always going to be a Simon, just like I feel like there will be a mid-class, there will be outlet malls. That if Simon owns all the outlet malls, I don't know. They own Chelsea, which, is no longer publicly traded, but look how well that merger worked out for them, especially in Asia.
Well, if only Macerich could turn the clock back, right? When Simon was trying to buy him.
Yeah.
I don't think anybody would be shocked to see one public mall out there. I think Simon, look, they went after Taubman and Taubman rejected him, and then once they got their arm around Taubman, COVID hit, and Simon wished they waited a little bit longer to do it. Not sure that they would rush in to buy Macerich until there was a real massive opportunity. But I would never bet against Simon Management, that's for sure.
And do you see the big US REITs as continuing to look for growth outside the US at all? Or do you think there's still enough growth in the US for them to stay happy? And that can be across sectors, not just retail now. I mean, we're seeing it at the data centers a bit. Do you think some of the other sectors will start to do this too? You're
seeing it here in the net lease REITs with like Realty Income and WP Carey. You're seeing it with a couple of the healthcare REITs with I believe it's Medical Properties and a couple of these other guys. They are starting to tiptoe overseas. I think if the right opportunity comes along at the right pricing, everybody will take a look at it. But for those that are really domestic focused, like if you're a Sunbelt apartment guy, as an example, you're not going to go start looking at apartments in the UK, just to throw that out there. But if you are a tower guy, towers are towers. You're going to go look at where the opportunity is out there. So I think the answer is it depends.
And the same with data centers potentially, yeah?
Oh, absolutely.
I would definitely agree with that. I would think that there's enough in the US to fill everyone's belly, but an opportunity is an opportunity. It also depends on your business.
So if we look forward 2 years or so from now, what's your feeling of what the landscape looks like, Ray? I mean, I know forecasting is always a fraught business, but just to get sort of where you think things are probably going to land in the next 2 years or so.
2 years, not even sure what I'm having for lunch. It's hard to say because I think that you could probably look at the changes that COVID accelerated and expect probably a lot of that to continue. I would not bet against the coastal markets, like we talked about, making a decent comeback within. I mean, 2 years is a long time, but it's too long of an answer. You have to go back by sector again from there to do it.
No, that's good. David?
I think it's, as we stated, it's really a sector by sector, but it's pushed new concepts to the forefront that really hadn't been considered before. It's proved that new technology and ideas are working. It's bringing innovation across different concepts that we hadn't seen before. And, again, where challenges lie presents opportunities. And so I would love to say we'll be back where we were before COVID and that much stronger. Who knows? Some stuff may go by the wayside. A great example of this is ghost kitchens. For those that don't know, a ghost kitchen is it's a space that's used to cook food for pickup and delivery drivers. You can't sit there and dine in, but you're noticing a lot of these guys utilizing it as a concept. Another example, before all this stuff hit, there was a huge push towards esports. And I'd love to see how it's going to play out with if we all go back to the malls as they convert some of their anchor tenant properties towards an esports venue to draw in youth and millennials and folks to watch video games and stuff. So again, I feel like there's pockets of opportunity, but boy, if I always say, if I knew the answer to that question, I'd be on my G5 on my way to Fiji in my $50 million house. So I wish I know.
Right, and then we do have a question that's coming. I think I'll tie it into a bit of a double thing, which is looking at renewable energy and REITs. And I think I'd like to tie that into your guys' views and thoughts on the whole ESG wave in a way that's basically hitting, I think, investors and fund managers alike that we're starting to see come through. Your thoughts on how REITs can continue to drive and utilize renewable energy, and then ESG as a general comment as well?
You gotta let the guy from Texas answer that one first.
Well, we had one infrastructure REIT that didn't make it, and that was HIFR. So I don't know. But in the grand scheme of things, I personally feel that, go ask any REIT executive right now, from A to Z, and every single person would tell you their number one initiative right now is ESG type stuff. They're bringing in ESG executives. They're carving out parts of their C-suites to focus on ESG initiatives. So yes, there's a huge way to go. I think what that landscape looks like 5 years from now is dramatically different than what it looks like today. A great example of that, go back to New York office, Empire State Realty Trust, ticker ESRT, which owns the Empire State Building, just signed a contract 2 weeks ago for all of their properties to be run by wind power. They're making a huge push, and some of these other guys are making a huge solar push. And so, especially with a lot of the industrial guys, a lot of the industrial REITs are putting solar panels on their roofs. And so, yes, there's going to be a huge return for the REIT sector when it comes to the ESG space, no question.
And it's big everywhere. I mean, every sector is talking about ESG. Raymond James has an ESG report that we put out on a regular basis on how it affects all the different subsectors. I think when it comes to the environment, one of the biggest question marks, and you can tie it back into the Biden administration, will be, is there going to be a Green New Deal, which is going to create some huge CapEx issues for some guys? If you need quadruple insulated windows now and whatnot. But that all remains to be seen. But as far as ESG stuff, I think REIT's actually going to do fine there.
Excellent. Thank you very much. And yeah, I think everyone, we've hit the time limit, and well aware that for David and Ray, your day is really beginning. And I'd really like to once again thank you very much for your time and insights. It's always a pleasure having you on, and I'm sure the audience definitely got some value from it. Again, also to thank our audience for joining us today, taking time out of your day to spend with us. If you have any further questions, we'll get to them, send them through to Olivia, and we will get back to them post. We're always happy to do that. Once again, thank you. Please be safe. We wish your family safe, and hopefully the next time we're doing this, we will be talking about the post-COVID world that is the reality. Thank you very much. Have a great day. Goodbye.
Thanks very much. Take care. Thanks, David.
Bye.